Welcome to the Allan Small Financial Show. As always, I want to thank all of you for taking the time out of your busy day and to spend some time with us. We have a great show, as always, for you today. We have a fantastic guest, a very timely guest for our show today. We have Ian Lee, Associate Professor of Management at the Sprott School of Business at Carleton University. Ian is a fantastic guest. We've had him on our show before. He's going to talk to us about the economy here in North America and Canada in particular. He's going to talk to us about the conflict in the Middle East. Ian actually taught EMBA program out of Iran many years back, so he's very familiar with the Strait of Hormuz and all the I guess the headlines coming out of Iran over the past I guess month or so. Ian is a great guest to talk to us about what's going on and the effects of the conflict in the Middle East on our economy here. So we're going to air that interview in just a few moments. But let's put up what other topics we have on our show this afternoon. As always, after our great interview, we're going to have our top three things to consider over the next 5 to 10 business days. Very popular segment for our show. These are three things that I think individual investors need to be focusing on before you make your investment decisions. Stagflation worries. Do we remember what stagflation is? We've spoken about this term on our show many times before. It basically is rising costs and slowing growth, and very difficult to navigate stagflation. We'll talk a bit more about that. AI opportunities continue, and we just had a keynote speech by Jensen Huang, the CEO of the very famous now CEO of NVIDIA, the largest company in the world today, largest chip maker in the world, and talking to us a bit about how AI just continues to soar. Everything to do with AI, whether it's chips, whether it's software, whether it's the rack, whatever it is, whether it's GPUs, TPUs, CPUs, yes, all this terminology, all these acronyms. It's a fantastic keynote that he gave, and some really interesting data or statistics he provided for us. So we're going to get into AI opportunities and show you what's been going on in the world of artificial intelligence. Quick hits. These are three things that have been in the news over the last little while that I found interesting, and I wanted to make a comment on each of those. And last but definitely not least, your questions. If anybody has any questions regarding the interview with Associate Professor Lee, please put them in the chat box. If you have any questions regarding any other material on our show today, please put your questions in the chat box, and we will pick those up throughout the show. And I always like to answer one or maybe even two questions before the show is over. Some of the questions we received throughout the 2-week period from our last show, but definitely like to get to as many questions as we can. And if I don't get to your question on this show, definitely answer it on our next show. So without further ado, let's get on with the show and an interesting and information-packed interview with Ian Lee, Associate Professor, Carleton University. I'd like to welcome Ian Lee, Associate Professor, Management at the Sprott School of Business, Carleton University. Ian has had multiple appearances before the House of Commons and Senate committees and is regularly interviewed by key media across the country on economic and business matters. Ian has taught strategic management, Carleton, since 1988 and taught it in EMBA programs at universities around the world, including US, China, Poland, Romania, Cuba, Ukraine, and Iran. Interesting enough, among others. Previously, he worked in the financial services sector. Welcome back to our show, Ian.
Thank you very much, Alan. I'm really pleased to be talking about this just because it's just so critical to the world.
Yes, a lot of things going on right now. And thanks again for being with us. I thought we'd start off a little different. Want to talk a bit about volatility because Lord knows we've seen a lot of volatility. Investors have seen a lot of volatility. Volatility index has spiked, the VIX. Yes. Price of oil has been up and down and all around. Changing with all the headlines coming out of the Middle East. So with all that in mind, what would you say, what would your comments be to investors? I've commented on, on the situation, on who's actually doing the selling out there right now. And we all know that a lot of the trades these days are done by computer algorithms, computer
Yeah.
trading programs, etc. So
Yeah.
we know that it's not necessarily the retail investor that's hitting the sell button on us here, but the market volatility is so at times extreme and at times it pulls back a little bit. But what would
Yeah.
your message be to investors today based on obviously what's going on in the world currently?
Alan, I appreciate the question, and I'm not a day trader. By the way, I have no conflicts of interest. I have no investments in any of these companies. All I do all day long as a professor, other than teaching my classes, is I study data. And when I say data, I'm not talking stock market data like you do, not criticizing that. I study I call it economic fundamentals. What's the total annual production daily, or the daily production of oil around the world? What percentage comes from, the Persian Gulf? What percentage comes from Iran? What percentage comes from Saudi and the United States? I use the international agencies such as the International Energy Agency, which publishes awesome stats, by the way. So does the IMF, so does the World Bank. I use these, and I'm looking at aggregates. I'm not looking at, some little obscure price point movement in one little part of the world. I'm looking at the aggregates because it affects the global economies. It affects the US. It affects Europe. So where I'm going with this is that I've had a running argument with some people who are environmentalists. Nothing wrong with that. They're decent, honorable people. But I've been very critical of this idea that's been out there for the last 3 or 4 or 5 years, not just in Canada but elsewhere, of this peak oil. Oil's about to, disappear. We're not going to use it anymore, and just around the corner, maybe 2 or 3 or 4 years from now. And I've always thought that this was a load of phooey on steroids. If anybody looked at real data, the consumption daily, annually, by region, by industry, it doesn't matter. You will see that we are still the world is fundamentally dependent on oil and natural gas. Yes, coal has declined very dramatically in the last 10 years, and yes, it is a fossil fuel. And I think the environmentalists have overinterpreted the trends because they've seen coal declining, and therefore I think that they've said, oh, that means they're all going down. If one looks at the hard data from the IEA or other similar international agencies, or the US Department of Energy, or Canada's Natural Resources Canada, you'll see that oil and natural gas are the two largest sources of energy in Canada, in the US, in Europe, in the world. They dwarf the percentage provided by renewables, the percentage provided by nuclear, the percentage provided by any other type of energy. And it's well over 50%. It varies from country to country. In Canada, I think it's 65% of the totality of energy comes from oil and gas, similar in the States. And so my point, that's the first point. The second point is that energy lies, as Daniel Yergin, the brilliant energy historian who won the Pulitzer Prize, has shown, energy lies at the very center of the modern economies around the world. I like to remind my progressive and green friends, all our classrooms across Canada and the United States are heated by natural gas. All of our hospitals, you go to the hospital, you got to go to the hospital when you're sick. It's heated by natural gas. All our tall buildings, most of our tall buildings, where we work in our offices in Toronto, in New York City, are heated by it. So my point where I'm going with this is oil and natural gas are absolutely crucial no matter what industry you are in. Even those people who think they're completely disconnected. I drive a Tesla. I'm off the grid. No, you're not. Food is produced. Food consumes energy to produce the food. Students go to school in a bus that's driven by diesel, and just goes on and on. So my point is, the reason for the volatility is not because of day traders or computer trading. It's because of the fundamental economic reality that there are no good substitutes for oil and gas. Yes, renewables are coming on strong. Don't deny that. And for those who say he's denying I'm not even getting into a debate about global warming. I'm not denying global warming. I'm simply saying when you look at the macro data from the IEA or the US Department of Energy, oil and gas are the largest single source of energy in the world, and energy is absolutely essential in this world. Every time we've had an ice storm in Ottawa and we've had blackouts for 2 or 3 days, then we go back to the Stone Age. And that's when we find out how completely dependent our economy is on energy, whatever, however it's generated. Your fridge doesn't work, your computer doesn't work, the charger for your cell phone doesn't work. Nothing works. And then we become, I remember the ice storm of 1997, where we were out of power, some of us for 3 weeks. I was out of power for 5 days. You're just completely, you just can't function. Your fridge isn't working. Your heat isn't working. I had to heat my house with a fire, of a wood fire that I happen to have. And so my point is, all of this volatility is not because some nefarious people, gnomes of Switzerland, or somebody hiding in the basement as a Wizard of Oz. It's based on the fact that the modern economy cannot function without oil and gas. It comes to a halt. It locks up. It shuts down. That's not a theory. That's called human reality.
So brings me to, I guess, a question or maybe a point. It had this conflict happen maybe 10 or 15 years ago. I would have, you would think that, or at least if it happened 10, 15 years ago, you would see the markets reacting a lot more. You
I
would see the
agree.
big spike more. You would
I
see
agree.
the S&P 500, maybe it's down 3 to 5% from its all-time high today. I'm sure that would have been greater. You would see a bigger fall 10 or
Yes.
15 years ago. So why do you think the market is as resilient as it's been for the last couple of weeks, even in the face of this Middle East war? What is different today than perhaps 10, 15 years ago?
Huge. And it's all in the data. Believe me, it's in the data. We've been told, let me make this very sort of personal to us here in Canada. We've been told by Mr. Guilbeault and others, environmentalists, and I'm not trying to trash them. I'm just saying that they're not evidence based. They've been telling us, our global warming, our emissions, excuse me, are going up, 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 up in Canada. We're just bad, bad, bad. And that's only a partial truth. If you go to the data from Statistics Canada and the Natural Resources, the Ministry of Natural Resources Canada, they have the data going back to 1990 all the way to the present. Emissions per person has gone down every year since 1990, not just in Canada, in the US, in Europe, around the world. People say, what are you talking about? We've been making our cars vastly more fuel efficient than they were in 1990 when we drove these great big honking, I called them boats, 5, 10 miles a gallon boats. Our houses, we've been retrofitting them steadily for 35, 40 years. We're all at the Home Depot and the other, hardware stores buying the latest windows and the latest energy efficient devices. Our appliances, our fridges and stoves and air conditioners are vastly more fuel efficient, energy efficient than they were 20, 30 years ago. Where am I going with this? We are producing far more GDP per unit of energy today than we were 20, 30 years ago. We are less dependent, but still dependent, but we're less dependent than we were 30 years ago when we were gas guzzlers, we were energy guzzlers. Our airplanes today are vastly more fuel efficient. If you look at Boeing or Airbus and the engines, their fuel efficiency has gone through the roof because we've been spending billions and billions and billions on developing more efficient engines, more efficient appliances, more efficient automobiles, more efficient housing for in the tall buildings and in residential homes. So the point is, we're getting a lot bigger bang for buck for a given barrel of oil. So that doesn't explain why our emissions have gone up in absolute terms. And this is where I've been very critical of Mr. Guilbeault, the former environment minister, for not leveling with Canadians. The reason our emissions went up isn't because we became more energy inefficient. We were becoming more energy efficient. The emissions went up because the absolute number of people in Canada increased very dramatically from immigration. And no, I am not blaming immigrants. All human beings consume energy. You eat food which is produced with fossil fuels. You get on the bus, or you go to a classroom heated by fossil fuels. So my point is, we went from 25, 28 million people in 1990 to over 40 million. And the sheer absolute numbers of people consume more energy, which produces more emissions. But the more important metric is emissions per person went down, down, down. So we are using proportionately less oil and gas today, much, much, much less than we were in 1990 or in 2000. So that explains why the markets aren't as, they're not freaking out, to use a phrase of my students. They're not freaking out today like they were. I remember I was just a teenager, I think it was a teenager in 1971 when the price went from $2 a barrel, I think it was to $12 a barrel. That caused, that just, it was just catastrophic. I mean, that was the first oil crisis, and they had lineups in the United States. I watched it on TV that ran for 2 and 3 miles from a gas station because they
Yeah.
literally ran out. Those days are behind us. We're much more fuel efficient. Yes, we are transitioning, but it's going to take at least 50 years. In the meantime, we're absolutely dependent on energy for the economy in every country, whether it's China or America, European Union, or Canada. Alan, I want to get one more quick point out before I run out of time because I think this is really, really important. What this the whole the Iran war and the Persian Gulf crisis is showing, and I listen, if I can figure this out as a professor, I'm sure that the leaders of Germany and France and Italy and China and South Korea and Indonesia and India and Japan are all figuring this out. They're all saying, "Oh my God, look at how overwhelmingly dependent we are on Mideast oil coming out of the Persian Gulf." And you can bet there's planners and people that do the scenario modeling right now in every one of those governments saying, guys, when this is over, we've got to start diversifying our source of oil and LNG. So it's not dependent on a 21-mile wide Strait of Hormuz. We've got to find some countries that aren't subject to the economics of a Strait of Hormuz. Hello, Canada. Hello, Canada. We need your oil and gas big time, because you have three oceans, the Arctic, the Atlantic, and the Pacific, and none of them are constrained by a strait that's 21 miles wide. You can send ships out in all directions for thousands of kilometers across those three oceans that are around Canada. And you have enormous quantities of oil and LNG. So what I'm predicting is that those countries, not one, all of them will be banging on our door in the next months to come, saying, Prime Minister Carney, we need a lot more. We're not talking 2% more. We need billions and billions more of LNG and oil from Canada, from the West Coast, the East Coast, and possibly from Churchill, Manitoba.
Thought we'd end the interview with kind of a general question about the economy. And I guess, generally speaking, do you think that there's anything else going on that is causing the markets to be as volatile as they are, causing the markets to be down off the
Yes,
highs?
yes.
We're getting weak GDP numbers both in Canada and the US just this morning. The second reading showed half of what it was on the first reading, 0.7% growth versus 1.5% growth. We're seeing jobs data coming down negative for the last in Canada and the US for the last month. Um, and is it something to do with USMCA, trade, tariffs? Have you heard anything about the trade situation between Canada and the US? What is happening perhaps outside of the conflict in Iran that perhaps could be putting some pressure on the markets currently?
You mean just in Canada?
In Canada, in the US, North America in general,
North
yes.
America. Okay, good. Thank you for putting that frame on it. I think that they are what you described because they're fully absorbing in or pricing in, if I can put it that way, the volatility of Donald Trump. Donald Trump himself is a volatile individual, and I'm talking about his policies, his unpredictability. And what I think the market is showing day by day by day, and I can't believe, I must believe that the people in the White House are communicating this to him privately, is that his actions increasingly are undermining him. He is his own worst enemy in the sense that it's his instability or volatility of policy predictability that is roiling everybody. I mean, markets don't like uncertainty. I've been teaching that for, my God, since I was in the bank lending money. Markets and companies and business investors hate uncertainty. But Alan, I think that what's going to happen, ironically, because of the Persian Gulf, he needs a win back here for the fall. And he needs a win in the Persian Gulf. We've already said that, or he will not, he'll lose the house. I think he's going to look, I think, ironically, because of all this mess, that this is going to increase Canada's bargaining position. I didn't say it's going to turn us into the whip hand, give us the whip hand, but Canada is going to be going into these negotiations with a stronger hand than before, because now we can be saying to Donald Trump, the prime minister can be saying, as Hextra, the ambassador, has been saying for the last 48 hours, critical minerals are number one now in the new negotiations because they see that as a huge win. They can say, if they produce a CUSMA well before the fall elections, that they got a CUSMA that assured supply of critical minerals, which the United States desperately needs because China's got them by the throat. Because the Americans are desperately short of critical minerals. China has a huge amount of the 94%, I think it is, of the world. And if we become their preferred supplier and make a commitment to accelerate, I mean, super accelerate the development of critical minerals in Quebec, in Newfoundland, Labrador, in Ontario, then we can, he can have a trade deal, which he can brag about. I got a trade deal. I solved the problem of critical minerals, and that'll give him greater credence at the polls this fall. So this crisis in the Gulf is going to feed back into Canada because it's going to put increased pressure on the White House to have an additional deal, I predict, that he can brag about because most Americans are not that focused, other than the price of oil, on what's going on halfway around the world. But they know much more. They're much more conscious about Canada. And that's why you see increasingly congressmen, Democrat and Republican, speaking up for Canada in the last literally 2, 3, 4 weeks. And so I think that we are going to have some additional leverage. I didn't say it's going to be a slam dunk, but I think that this is going to increase the probability of a trade agreement. I'm not saying we're going to get tariffs removed on cars. I'm not talking about that. But I'm saying that the critical minerals, because we're fourth largest reserves, I believe, in the world. And we haven't developed them, but we've got the reserves. And that's going to be I think, a game changer for getting a deal with the Trump White House, which is in our self-interest as well as the United States. So I'm ending on a more positive note. I see some good coming out of this.
It'd be great if we have some leverage. Not many people have leverage on President Trump these days. So if this gives us the leverage that we need to get a deal done, that would be fantastic.
Yes. Yes.
Ian Lee, Associate Professor of Management at Sprott School of Business, Carleton University. Thank you so much once again for coming on our show and shedding some light on what's going on in the Middle East. Everything from Middle East, oil, politics, a little bit in there. We had a bit of everything. So thank you so much as always.
My pleasure, Alan. Really enjoyed it. Thank you.
Thank you. What a great interview. Associate Professor Ian Lee, so passionate about the economy, about what's happening in the world today. It'd be a great thing, I think, for all of us to sit in on one of his lectures at the university. I can only imagine how passionate of a lecturer he actually is, and a great person. So thank you to Ian for being on our show once again. Now we come to the part of our show that is actually quite popular. It is where we talk about three things, and there they are, that individual investors need to be focusing on before they make their investment decisions. And three interesting ones today. Investing strategy amidst this volatility. A lot of volatility out there, yet investors seem to be taking it a little bit more in stride than they usually are. We're going to talk about, what investors should be doing during these volatile times. Oil shocks and the effects on the markets. Obviously, rising oil prices is having a tremendous effect on the markets today. As oil prices get closer to 100, exceed $100 a barrel, we tend to see the markets pull back in lockstep. And number three, Bank of Canada and Fed interest rate policy decisions. It's funny because today is a central bank day, and anytime we have our show on a central bank interest rate decision day, it's usually the top thing that we have for this segment. Yet today, it is the third point in our segment. We know the Bank of Canada has already announced its interest rate policy, and basically they said that interest rates are on hold. They are not cutting them. They are obviously not increasing them. So they're going to maintain their rate at 2.25%, which is the Bank of Canada rate. And now we're waiting to see, coming up, I guess, within the next just over an hour's time, an hour and a half or so, we're going to get the Federal Reserve in the US announcing their interest rate policy and what they say definitely can move and has moved and will move markets. And then their press conference, of course, will follow. So let's move forward with our first topic, which is investing strategy amidst market volatility. And as I said, investors seem to be handling this current volatility a little bit better than what I've seen in the past. Usually I get a lot of investors emailing me, calling me, Alan, is there something we should be doing? The portfolios are lower this month, and we are seeing the markets falling 3 to 5% on the S&P 500 over the past 4 weeks or so. Really since the end of Feb when the conflict in the Middle East began. But investors are not doing that this time. They're not emailing me saying, is there something we should do? Or at least I'm getting a lot fewer individuals asking for or wanting to make changes and perhaps doing things based on emotion. I think investors actually are actually doing the opposite. I've actually had probably more calls this time about trying to find opportunity in this volatility and volatile times than those that are concerned or worried or want to make changes. So perhaps investors are finally realizing that unfortunately wars are always a bad thing. They're always negative, lives lost and so forth. But with respect to the markets, at times when the markets do pull back because of a conflict, there are opportunities out there that can be had. And this is a time where investors can perhaps take advantage of those. So but I do understand, why people do get emotional and why they get a little bit nervous when they see volatility. And our first chart here of the S&P 500, a year-to-date chart, clearly shows the volatility. And you could see the S&P 500. Look how volatile it has been since the start of the year. January was slightly positive, flat to slightly positive. February, again, hung in there, not too bad. But as we got closer to March, and that February 28th date where both US and Israel went into Iran and began this conflict or war, you could see the markets really start to fall off the first couple of weeks of March, and really not until the last week or so. And you're starting to see markets rebound and start to say, hey, you know what, perhaps things aren't as bad, and maybe there are some bargains to be had. Our next chart also shows the volatility index. Again, you'll see the volatility index really spike higher the first week of March. Look at that spike higher in and around 30. Now it's down around 22. We've seen volatility start to come down. And again, I think that has a lot to do with obviously the war, how the war is going. We're starting to hear just now that there are some tankers getting through the Strait of Hormuz. A lot of those tankers are bound for China and India. A lot of them are Iranian, and the U.S. has said that they're letting tankers get through. So we're starting to see little dribs and drabs of oil getting through the strait, and I think that has done a lot to bring down the volatility index. Keep in mind, the volatility index to start the year was somewhere around 13 to 15. So we're still well above where it was at the start of the year. Our next chart shows the price of oil and the Brent crude oil. There you have it. And you can see again, why would volatility or people become nervous and volatility spike? Well, you could see that recently Brent crude, when you look at when the war or when US began to attack Iran, the price of Brent crude, so this is the price of oil in Europe. We also know WTI, which is the price of oil in the United States, and Western Canadian Select is the price of oil in Canada. So a few different prices, but this is just looking at the price in Europe. Almost spiked as high as when the conflict with Russia-Ukraine began, I guess, a few years back now, back maybe about, wow, can you believe it? 6 years ago, almost 5.5, 6 years ago now. Actually, sorry, my apologies, about 4 years ago, 2022, that conflict began. You could also see when the pandemic started, COVID, that you could see where oil fell because obviously people weren't moving and oil wasn't needed as much. So again, understanding oil spiking, understanding that whenever there's a conflict in the world, a major conflict, that investors can get jittery, markets can get jittery, and we did see a sell-off over, let's call it the last month or so. But I think our next chart, and this chart really shows why investors have limited, for the most part, the declines, especially in North America. And this is a chart about the impact of war on the markets. And there you have it. And you can see in column three the amount of months to recover. So you had the Korean War many years ago now, took 2 months to recover. 1 year later, 31.7% higher were the markets. 2 years later, almost 50% higher. If you scroll down, you can see 1979 to the 80 oil crisis, so similar to an oil crisis that we're seeing now. What happened with the markets? 17% decline. How long did it take to recover? Oh, just 3 months. And then 1 year later, the markets were 37% higher, and 2 years later, 14% higher. You could see on the far left side, JFK assassination, Cuban Missile Crisis, et cetera, all these different times, Asian financial crisis, took 1 month to recover. So you can see that whenever we have a major crisis, if investors were to look at these times as opportunity, which is what I think investors are looking at now, at least it feels that way with the conversations I've had with many investors, you can see how quickly markets do rebound once the conflict ends. And yes, I know sometimes it feels like the conflict will last forever and it will never end, but the conflicts do end. I know the Russia-Ukraine situation is still ongoing, but hopefully we're getting close to a resolution there, a bit of a ceasefire. And the conflict in the Middle East now with US, Israel, and Iran will come to an end in some way, shape, or form, whether it's a ceasefire or some other ending to the conflict. So when that happens, history tells us that markets do improve and will go higher. And I think individual investors need to be mindful of that. And we have a couple of other charts here. Interesting enough, I wanted to put a couple of charts on inflation. And our first chart shows the CPI year over year change. There you have it. In Canada, you're looking at a CPI or inflation rate now of 1.8%, below 2% target that the Bank of Canada would like to see. And if we go to our next chart, you're going to see US CPI, and you're going to see there you have it, that they're sitting at around 2.5%, just a hair above what the the Federal Reserve would like to see as a target rate. So the biggest concern with whenever you have an oil shock or a war or a conflict in the Middle East, especially, that affects the price of energy or oil. We all get nervous because how is this eventually going to affect higher costs, higher pricing, which obviously is inflation. And that is the main concern that the market has, investors have, that if a conflict goes on for too long, that it will affect the inflation rate. But you can clearly see that we're coming into this situation at an inflation rate that is below target in Canada and just slightly above target in the US. So a lot of room there. And we'll have to see in the coming weeks whether or not the higher oil prices that we've seen over the last few weeks will start to filter into inflation and higher costs. But for now, I think, with respect to investors, they're handling the volatility quite well. And I guess the strategy would be stay patient, continue to look for good quality investments like you always have in any market. And I think if you can do that and sort of filter out a lot of the noise, a lot of the geopolitics, I think that is the best recipe for success. Our second topic is regarding oil shocks and the effects on the markets. Obviously, we've seen a lot of volatility with oil, and probably and the easiest effect of higher oil prices come with oil stocks, right? And I have two oil stocks that I've chosen, but you could choose many of them. Our first one is Canadian Natural Resources, a big oil company here in Canada. Take a look at that chart. Wow. The price of for the shares were going up prior to the war breaking out. But take a look at towards the end of February and into March, price of oil has really moved significantly higher, and Canadian Natural Resources is trading just off all-time highs. So that's a big Canadian oil company. Let's take a look at a very, very large US oil company in Chevron. There you have it. Chevron as well. Taking a look at where the stock has gone, really jumped. It looks like somewhere around the first week of March. And it's interesting because you're seeing this price of oil moving higher. You're seeing most oil stocks following. I get a lot of questions sometimes. Do you buy oil itself or do you buy the shares of oil companies? And well, I can tell you the shares of oil companies are really doing extremely well. So that's, I guess, for investors, the positive of higher oil prices and the volatility that comes from higher oil prices. But now, unfortunately, as we all know, there are a lot of negatives. Our next chart shows the Asian markets, and the Asian markets most reliant as a percentage of total energy products passing through the Strait of Hormuz. And keep in mind, the Strait of Hormuz is that narrow body of water, as Professor Lee, Associate Professor Lee mentioned, 20 miles, I think he said, across. And Iran has tried to shut down, I guess successfully, over the last week or two, shutting down that strait and oil tankers having a difficult time getting through. But you can see here the dependency of a country like Japan, 95% dependent on passing through the strait for their energy, for their oil. You can see natural gas only 11%. The next highest would be South Korea, 70% dependent, and China, 50% dependent. So when oil is having a difficult time getting through the Strait of Hormuz, these countries' economies and obviously their markets that reflect their economies are negatively impacted. Our next chart we have here talks about oil and gas benchmarks and how much they jumped higher when the conflict in the Middle East began. You could see here that, for example, oil right in the middle, WTI, 44% higher. If you look at right beside it, Western Canadian Select, you're looking at 51% higher. And there you have European Brent was up over 40% as well. So all the oil and the costs really started to move higher, again, affecting markets, affecting countries. There's no doubt that oil not passing through the Strait of Hormuz was starting and has been affecting these countries. Next chart actually shows the biggest impact on stock market and also shows the resiliency of North American stock market. So most equity markets sold off as the war broke out, but some showed signs of resilience. There you have the chart. So take a look at on the far left, China. Interesting enough, 50% of their oil comes through the Strait of Hormuz. We know Strait of Hormuz was basically blocked for a little while, although now we're starting to see tankers from Iran getting through on their way to China. But China has such large reserves built up for oil that their stock market barely budged, 1.5% decline. The United States is now the largest producer of oil themselves, and they don't need to rely as much on what's going on in the Middle East. Their markets, the S&P 500, would decline as it is there, about 3.5%. I can tell you it's between 3.5 and 5, depending on the day. Canada, TSX, obviously, we're a very large producer of energy as well. We're sitting at around 4.5% decline in our markets. But if you look at some of the other markets around the world, South Korea really was on fire prior to the war. And this was on the back of technology and memory chips. Some of the biggest companies like Samsung out of South Korea that produce memory chips were just doing extremely well, carrying their stock market higher. But obviously, now that the war has broken out or the conflict has begun, South Korea and Japan and even India have seen their stock markets fall quite a bit more than what we've seen here in North America. Let's take a look at our next chart, which shows the individual sectors and how they've performed since the war has broken out. Percent change as when the war started, you could see obviously energy, the only bar that's going to the right. Everything else is going to the left. Technology, it was interesting. I was on BNN, Business News Network, not that long ago, and I had said that I felt, of course, energy moving higher, but outside of energy, I thought that technology made a lot of sense for individual investors because it was somewhere that I thought investors could, as I put it, hide out in a sector that you could buy some stock in different tech names. And I didn't think it would be affected as much as perhaps some of the other sectors of the market, industrials, consumer discretionary, real estate, other things that you're seeing here that are down a lot more. The S&P 500, again, down in the middle there, 3.5%. So I thought tech would be a good place to invest in. I thought a lot of tech names were already cheap coming into this conflict in the Middle East. And as you can see, tech really down 1%, on March the 16th when this chart was taken. It was not only one just over 1% for the tech sector. So I thought a good area to invest money. Our next chart shows our famous Magnificent Seven stocks, the Mag 7. And you can see that prior to February 28th, when the war started, you can see that the Mag 7 stocks were all, or at least the group, was down substantially. Most Mag 7 names, most of the seven stocks that make up the Magnificent Seven were down. But the interesting thing is, since the war broke out, you could see little blips higher in the group. And I think, as I said, I think investors feel as though they were beaten up so much that they would be definitely a good place to invest money. So effects of the war on basically the effects of the war on the markets. I think they've had obviously a tremendous effect on the markets. The markets seem to be moving in lockstep with the price of oil. As oil surges higher, stock market goes down. As oil comes down, markets go higher. And I think that is going to remain in place for the foreseeable future until we start to see some, I guess, some positives on the resolution of this conflict. Hopefully, we can see that soon. I know President Trump has said that he anticipates the war not to last that much longer. I think he believes they're making huge strides to bring this conflict to an end. So we'll have to see what happens there. Our third and final point to focus on as individual investors before you make your investment decisions, and that would be what the Bank of Canada has already said this morning and the Federal Reserve and what they're going to say this afternoon. Our first chart shows the Bank of Canada, and it will show you what they've done. There you have it. Their rate decision, keeping interest rates in check or the same, not cutting, not raising. And you can see here that it's now been 4 meetings since they've done anything. The one in October, actually, they cut a quarter point. So it's been 3 meetings since they've kept that rate the same. It's been dropped down to two and a quarter, and has been there since the end of October of 2025. Let's take a look at the next chart, which is the Bank of Canada policy interest rate. There you have it. You can see it coming down and then flattening out on the right-hand side of that chart. You can move now. Let's go to the Fed funds rate, the target rate for the Federal Reserve. And you can see that, we have there it is. Perfect. Thank you. The Fed funds rate for the Federal Reserve, you can see there that it has come down to 3.5, 3.75%. I know that the administration would love to see this come down further, but with oil prices spiking, war in the Middle East, conflict in the Middle East, I think you're going to hear at 2 p.m. Eastern today that the Federal Reserve will keep interest rates in check or on hold. No cut, no raise. And I think what the market is going to be looking for and parsing through is their commentaries, the press conference after the announcement. So I think the announcement will be sort of anticlimactic, but it's what they're going to say going forward. And we know that Jerome Powell, the head of the Federal Reserve, his days are numbered. Kevin Warsh will be taking over at some point in the next few months if his confirmation actually goes through. Next chart here that we have is Canadian GDP, which is the chart. Yet, there you go. We had that pulled up quickly for a moment there. You can see Canadian GDP has been struggling. 2 out of the last 3 quarters have been negative. And I thought this would give ammunition, along with a 1.8% inflation rate in Canada. That could give ammunition to the Bank of Canada to be cutting interest rates to try and stimulate more growth in our country. You look at what the US is doing with respect to GDP and GDP change, our next chart, and there you have it. Their fourth quarter positive, but at one point they were thinking maybe 3-4% growth in GDP. Their first reading of GDP was about 1.5%, and then their second reading dropped to 0.7% growth. And that was quite disappointing in the US. Very quickly, let's show the Canadian employment data. We can see here that the last couple of months we've lost jobs. Again, Bank of Canada needs to be looking at this. They have that dual mandate. They want to have job creation and stable prices. Well, we're definitely not getting job creation. Let's look at the United States and their employment data. They too are seeing negative jobs growth this past month. So, kind of the two countries mimicking each other a little bit. And to me, that again, I think that if you look at what the Fed's mandate is, which is job creation, stable prices, I think you got the stable prices. And I think the fear is that higher oil prices will bring on an increase in pricing. And I think that is on both sides of the border. But I think if they focus on jobs, I think they should be both be cutting interest rates, especially here in Canada. I did some, digging of previous interest rates back prior to COVID in 2020, coming out of 2019. Our GDP numbers were not doing well as well. 1.9% growth back in 2019 at the end of 2019. Today, GDP in Canada is 1.7%. Interest rates, Bank of Canada rate back then, 2020, 1.75. Today, 2.25. So does that mean we can cut 50 basis points? I believe it does. I think we can look to cut interest rates. I know the Bank of Canada doesn't want to cut rates, but I believe they can do it. So definitely something to look for or understand and look at this afternoon when the Federal Reserve talks about their interest rate decision and as I said, gives their oppressor. Along with that, obviously, we want to look at the effects of oil on the markets. Keep that in mind when you're making your investment decisions and definitely not get caught up in the volatility and the emotion that the markets bring. So I think if you keep those things in your head when you make your investment decisions, I think you will be do a lot better in those decision making, in that decision making for your portfolio. Stagflation worries. As I said off the top of the show, this is when you have higher costs or higher pricing and lower growth. We actually have a definition of stagflation for us to all see. There you have it. An economic cycle characterized by slow growth, a high unemployment rate, and high inflation. Well, inflation is low right now. So, we're not really sure we have that stagflation type scenario. Unemployment rate is getting higher in our country. It is roughly the same in the US, 4.3, 4.4%. The unemployment rate here in Canada, 6.7%. So we're still not seeing the actual data that would lead us to say we are in the midst of a stagflationary period. But there's always that worry, right? There's always that worry that anytime you have prices, potential prices moving higher, especially due to an oil shock. And we saw shocks, I guess now about 40 years ago, the last time we saw oil really move higher. And we talked about it earlier on our show, the oil shocks of 1970s and early 80s. And so whenever you have that type of scenario where prices are moving up due to oil higher, price of oil higher, and therefore growth coming down, very difficult for central banks to navigate. Do they cut rates? Well, they can't really cut rates because inflation is higher. Do they raise rates? Well, they can't really raise rates because the economy is slowing down. So very difficult to navigate. And one can only hope that we don't go into a stagflationary type scenario. But for me, it's all going to be about how quickly this conflict in the Middle East finishes or there's a resolution there. And the sooner, obviously, the better for the economies in North America, but also all the way around the world. AI opportunities continue. And this was a topic that in figuring out our show for today and creating our show, I thought it would be interesting to put up, especially after CEO Jensen Huang gave his keynote speech at his conference, at NVIDIA's most recent conference that's been going on this week out in California. And one of the data points that he mentioned to me really hit home. And what he said was this. Originally, I guess a little while back, months ago, he had said that he could see a backlog. NVIDIA could see a backlog of about $500 billion in new business. Well, here we are this year, coming into this year. He now sees just with his two chips that are being used right now, the Blackwell chip, which is the prominent chip being used, and the Vera Rubin chip, which will be used later this year. Businesses getting the Vera Rubin chip, just those chips alone, he could see $1 trillion, trillion with a T, $1 trillion of business, backlog of business. Just those two chips alone. That doesn't include anything else. That doesn't include the chips that they make for autonomous vehicles, for gaming, or for any other type of business that they're involved in. And there are many other types of businesses. Just that alone, $1 trillion backlog. And that got me thinking, wow, AI is still roaring ahead. And anyone who thinks that we're in the later innings, we've seen peak spend, I think is just wrong, outright wrong. We still have, I think, a pretty large runway for AI spend, and for AI to really develop and continue to develop at businesses, big and small. We're seeing now, and you're going to see in a moment, that big businesses dominate with respect to AI usage, but the small businesses are definitely catching up. Our first chart actually is on NVIDIA. We can show now. The interesting thing here is after this fantastic forecast for where NVIDIA is going, look at the stock. The stock has gone nowhere. And it's interesting because I thought when they came out with that forecast, $1 trillion with just the two chips, I thought the stock would just skyrocket, and it did not. It's been trading in this tight range for quite some time. And for many of the bulls about NVIDIA, they say, well, it's consolidating and it's just going to go tremendously higher at some point. And we've seen targets of 250, even $300 a share targets for the stock. We'll see if this comes to fruition. But interesting how tight of a range NVIDIA trades in right now. The next graph that we have, or illustration that we have, I think is one of the best for this show today. And it shows the organizations and how increasingly they are using AI in the multiple functions. And so what you see here, business functions at respondents organizations that are using AI. That's the title for the chart. One or more functions, businesses that are using one or more AI functions have grown. 88% now of businesses are using at least one function. Look at two. Two would be 70%. Three or more, 51%, four or more, and obviously five or more functions. So I think that's just going to continue to increase and increase and increase. And you can see here how much run room we have for businesses to take on more AI, to use more AI. Recently, we just heard Meta. They may cut, or at least that is what is being talked about, as much as 20% of their workforce. A lot of that because of what AI is now able to do for their business. Our next chart here shows that, and I mentioned it briefly a moment ago, how big business is actually capitalizing more. Larger businesses are capitalizing more, and they lead the way in scaling AI beyond just pilots. And there you have it. So $100 million, less than $100 million companies, you can see a lot of them are still experimenting, the 100 to 500 million. But look at all the way to the right, 5 billion or more. You could see they're already scaling their businesses, and it is the most fully scaled there. So big business is starting or has started and implementing a lot of AI in their business right now. And you're starting to see smaller business follow the 1 to 5 billion next, and then the half a billion to a billion. And it's just going to get more and more and more. And I think that is the worry for government. What's it going to do to the unemployment rate, for young adults, for students? We're seeing that segment of the population most affected. But right now, it looks like most of the adoption is coming in large businesses. We're going to see smaller businesses play catch up, I believe, in the coming years. And so I guess the main message of this segment, and this is our final chart for the segment, is that AI is here. It is here to stay and only growing in its functionality. It's only growing in its usage. And companies like NVIDIA just keep telling us this when they broadcast their forecasts. $1 trillion in just two chips, backlog of $1 trillion. All I can say is wow. And if that's a sign of things to come, it only gets better from here. Quick hits, three things that I've seen over the last couple of weeks in the news that I wanted to comment on for all of you. President Trump upset as his U.S. partners reject call for Hormuz warship escorts. President Trump is asking for NATO countries as well as Gulf states to help get the Strait of Hormuz reopened and help escort tankers through the strait. And unfortunately, President Trump is saying that he's not getting a lot of assistance. China warns Trump, President Trump, latest tariff moves could damage trade ties. I know that because of the strike down of the IEEPA tariffs by the Supreme Court in the United States, President Trump has been looking for other ways to put tariffs on goods, and he's looking at some of the conditions. 60 countries, I think he's looking at labor conditions and other things, other reasons to put tariffs on these countries. Number three, NVIDIA is still years ahead of any competitor. Well, as I just mentioned, they're doing extremely well. And Dan Ives, a very famous analyst from Wedbush, he's famous for the way he dresses. If you ever see him on TV, you'll know him right away. But he talks about how NVIDIA continues to dominate. So let's move to our first quick hit. And this is President Trump. He's talked recently or spoken recently about how he's disappointed in a lot of NATO countries. A lot of countries he's asked to help with the reopening of the Strait of Hormuz. And these countries, he's saying, and correctly so, they need a lot more of the oil that's going through that strait than the United States does. And so he's asking them for help. And it seems like they are reluctant to do so. Our first chart and only chart for this quick hit clearly shows, there you have it, the start of the Iran war. Look how low or how little is getting through the strait once the war had started or the conflict started. So, President Trump is upset. Partners are rejecting his call for warship escorts. And he's saying that actually some of the Gulf states have been helping, but definitely NATO has not stepped up. Our second quick hit talks about China and the relationship between the US and China. We know that the US is trying to figure out other ways to put tariffs on countries like China. We know that there's a 10 or 15% tariff right across the board on all countries. Right now, we know that the president is going to China to have, I guess, conference with Xi Jinping, the leader of China. That might be delayed a little bit because of the conflict in the Middle East, but that meeting looks to happen. Our chart clearly shows for this segment exactly how the imports in from China into the US have been affected over the last, let's call it year and a bit. China imports have definitely dropped tremendously once the high rate of tariffs were put on Chinese goods going into the US. They've definitely come down quite a bit, but the imports have not really bounced back much since then. Our third and final quick hit that we have is talking about NVIDIA and the NVIDIA dominance and the conversation and Dan Ives. And we have a quote from Dan Ives that I would read. And basically the quote says that the reality is that NVIDIA is 2 to 3 years ahead of anyone, including Google. Google, they're making chips, TPUs, which is more custom chips, basically do one function at a time versus NVIDIA's GPUs, which is more general, do many functions at a time. But Dan Ives is saying NVIDIA is ahead of everybody, whether it's Google, whether it's other chip makers, AMD. NVIDIA is just too big and too powerful. So the last line here, so good here by Dan Ives. So it speaks to right now, demand and supply is 12 to 1 for NVIDIA chips. So demand versus supply, they can't make supply fast enough. And again, does that mean that everybody should be looking at NVIDIA chips to own? Well, NVIDIA stock to own, NVIDIA shares to own. Well, as you saw on the chart earlier, for whatever reason, it still hasn't panned out as the stock seems to be trade bound. So we'll have to keep an eye on NVIDIA shares. Perhaps it will break out in the coming weeks. What's my take? This part of the show where I like to take at least one or two questions from our audience. And I know our show's gone on a little bit longer than normal, our interview with Ian Lee was a little bit longer. But I do have a question here that someone asked me over the last couple of weeks, and it is, in this market, is it better to invest in small or mid cap stocks as they have more attractive valuations than many of the large cap stocks? And I guess at one point in time that was the case. A lot of large cap names were very highly priced, but over the last, I would say, since tech has pulled back a little bit, since the AI disruption of software stocks, for example, since we saw the tech industry pull back, since we saw spending increase, the market's getting a little jittery, and now obviously the conflict in the Middle East, I think you can take a look at large cap stocks. I think their valuations have come down. Yes, mid cap or small cap stocks have done extremely well, but I always like to buy best in class names. And to me, best in class usually means some of the largest names in the industry. I think you start there. I think, yes, you can look at small or mid cap stocks. They tend to be a little bit more volatile, which I think is obvious. They're smaller in nature and obviously don't have they don't have as much staying power at times. And these big cap, large leaders in their field or industry, they tend to have less volatility because they dominate the space or sector that they're in. So with that, I want to say thank you to everybody who joined us for our show today. Hopefully, as always, you took a little something from our show. I want to say thank you again to Associate Professor Ian Lee from the Sprott School of Business, Carleton University. Always a great interview. And I want to say to all of you, thanks for joining, and look forward to seeing all of you once again 2 weeks from today when we will have our next show, Wednesday, April the 1st. Yes, April Fool's Day. There you go. Wednesday, April the 1st at 12 noon across all social media platforms. And until then, happy investing.